Okay, good. And game plan for tonight is to wrap up chapter 5. We had gone through first part of chapter 5 last time, so I want to complete that tonight and then see if we can get to at least the leases discussion part of chapter 6. And we'll talk about towards the end of class tonight how we're going to handle the rest of chapter 6. But at this point, I'm going to go ahead and just jump us in to chapter 5 or module 5 of chapter 5. Remember last time we talked about primarily how to issue bonds, and when you issue bonds, those bonds could be issued at face, but for the most part using time value of money, taking the present value of the principal and interest payments. The bond will issue an amount different than the face. If it issues for more than face, the bond issues at a premium. If it issues for less than face, the bond will issue at a discount. And of course, the bond issues at a premium. If the stated coupon rate is more than the market rate, it issues at a discount. If the market rate is more than the coupon rate, it'll issue at a discount. The coupon rate is more than the market rate of interest, it'll issue at a premium. Hopefully I'm saying that right. So now what we're going to do is we're going to go ahead and turn our attention now to the amortization of those premium and discount here in this part 2 discussion. Now, on the CPA exam, they're going to see if you know the 2 different methods to amortize the bond. One is called straight line. The other is called the effective interest method. US GAAP, which is all they test on the exam, tells us that we have to use the effective interest, but they allow you to use straight line if it's not materially different from the effective interest method. Which I always find statements from the FASB like that a little annoying, because I would have to use the effective method to see if it was materially different from straight line. And once I've used the effective, why would I throw that information away and then use straight line? So on the exam, they ask you about both, but usually with straight line, when they're asking you that, they want to see if you can determine how the amortization of a bond will affect the interest expense for the period and how it will affect the carrying value of the bond. So we're going to put a flashcard on how amortization of premium and discount affect those 2 elements, the interest expense for the period, the carrying value of the bond, and we're going to see that the straight line method is really very easy. And then we're going to be looking at the effective interest method. Amortization of premium and discount still have the same effect on the interest expense and the carrying value, but the method of coming out with that amortization is a little more involved. And you will see questions like that on the exam, either in the case of multiple choice questions or very likely a task-based simulation. Don't forget, guys, I said last time that bonds constitute a 10-point area on the exam, long been a heavy area on the exam. Okay. All right, good. So with that, let's just go ahead and start taking a look at the amortization, okay? And we amortize the premium or discount, and we need to amortize that over the period the bonds are outstanding, okay? Over the period the bonds are outstanding. So go ahead and flashcard that, but just take a look at this illustration here. We have a 5-year bond, 60 months, but they don't get around to issuing the bond until November 1st. That means those bonds sat on the shelf for 10 months. So the outstanding period is 50 months, not 60 months. So if you were being asked, what's the amortization of a bond discount? By the way, amortization of bond issue cost would be the same notion here. You would amortize that over the period the bonds are actually outstanding, in this example, 50 months, okay? Now, as we have talked, okay, we can have the straight line method or we can use the effective interest method. Now, notice that the straight line method results in a constant amount of interest expense each period and the amortization of the premium or discount. is the same each period. They tell us that the straight line is not allowed by GAAP unless it is not materially different from the effective interest method, as I said, that we'll look at in a little while. Again, you'd have to, use the effective, or at least calculate the effective to see if the straight line was materially different. So it's a little bit annoying. You ultimately end up, the effect is as though you use, no pun intended, the effective interest method. But on the exam, they may give you straight line questions, which are very easy. You're going to see the little, formula here in a second. The calculation is very easy, but they're going to want to see, do you know how that amortization, premium, or discount affects, again, either interest expense or the carrying value of the bond. Okay. So when we do our periodic amortization, don't forget, guys, it's the number of periods outstanding. So we take those number of periods the bond is outstanding, that is in the denominator. And then in the numerator, we will simply have our premium or our discount and bond issue costs together. Again, bond issue costs are also amortized over that same period of time, the period the bond are outstanding. That gives you your amortization of the discount or premium. Okay. Now, when we look, our interest expense will always start out by taking the face of the bond. In the little example that we were using from the other time from last week, we had the $1 million bond, right? The interest rate, the stated rate on that bond was 10%. Since it was a semi-annual bond, we divided that by 2. And so that meant that we had what? Cash interest of $50,000 every 6 months. Okay, now that number doesn't change. That number is, not for every problem. The way you calculate it is the same. For this bond, it would always be 50,000. You could see a different question where the, semi-annual interest payment amount is different. It's not always 50,000. But for this particular bond that we've been using to understand this stuff, to review this stuff, it's been that same bond. It always pays 50,000. And then if we have a premium amortization, can't be both. It either has to be a discount or a premium. Then we would go ahead and we would subtract the premium amortization and bring that below the 50,000. If we were talking about a discount and bond issue cost amortization, we would add that to the 50,000 to come up with the interest expense. Okay. Now you look at this, and I'm going to give you a flashcard. In fact, you can go ahead and flashcard this here now if you want. I'll give you a different flashcard in a second. But you look at this, and it makes sense because what happens? Remember, the discount bond issued at less than face, but the day is coming when we are going to have to pay the full $1 million when that bond matures. So in effect, since the day is coming at the end of the 60 months, at the end of the 5 years, we're going to have to pay out the full $1 million, even though we only received whatever it was, 900 something thousand on the issuance of that bond. That in effect is increasing my interest expense above the 50,000 every 6 months. If it was a premium bond, I issued it for 1,081,000, whatever that number was on the premium that we talked about last time. And the day is coming where I'll only have to pay $1 million. I get to keep that extra 81,000. So that means that what? That means that my interest expense is actually less than that 50,000. So you subtract that premium amortization. Okay. Now you come over and you take a look, and we're going to look at the straight line. You're going to see, guys, it's pretty darn easy. Okay. And that we issue the bond. We issue the bond at a discount, meaning we issued it for less than face. Okay. So we have the $1 million minus what we issued it for. Remember, we use the market rate of interest to discount the interest payments and the principal payment. Present value of an annuity for the principal, present value of $1 for the present value of annuity for the interest, present value of $1 for the principal. We went ahead and discounted those and came up with a present value of those two streams of payments of $926,399. The difference between that and the million is $73,601. So we went ahead, we received the cash. we go ahead and we credit the bond payable at the face amount and we debit the discount. Now, at this point, the discount, I'm going to tee that up over here, is showing this 73,601. We debit it. So now it has that balance of 73,601. I'll tell you, there's nothing more annoying than it raining all day long. I mean, just clouds and rain and wind. And then the minute I sit down in this seat to teach the class, here comes the sun on my face. Okay, so let me just close that. Okay, good. I guess I should feel blessed, right? Okay, so we have this, what, 73,601, which is the amount of the discount. The bond payable is $1 million. Okay, and then we start to amortize that discount using straight lines. So we take the 73,601, divide that by 10. That gives me what? A straight line amortization that will not change over the 10 semi-annual periods. The 50,000 will not change. Again, that's what? That's the $1 million times the 10% divided by 2 gives me the $50,000. That will not change. Okay. Now, what happens when I want to figure out my interest expense? I add that discount amortization to the 50,000. That gives me my interest expense. And then when I want to figure out the new carrying value of the bond, I add the discount amortization to the previous carrying value to come up with that new carrying value. And I will continue to do that through these, 6 months intervals as I add that discount amortization, that previous carrying amount, to come up with the new carrying amount for the next period. And again, my interest expense, as we saw earlier, remains the same. So when you look at the journal entry, okay, the bond interest expense is the sum of the cash interest plus the discount amortization. I, of course, am going to credit cash for the 50,000 because I'm paying out my bondholders their entitled contract interest payment. And then I'm going to go ahead and I'm going to amortize the discount by crediting it. Now, when I amortize the discount by crediting it, and I credited this $7,360.10. Okay. And when I do that, 73,601. Right, just taking my calendar, 73,601 minus now $7,360.10 gives me $66,240 and 90 cents. And if you were to think what the balance sheet would look like on 6/30, the bond payable, of course, still has $1 million. Nothing changed there. Now the discount is what? 66,240. I guess I'm going to have to do the annoying 90 cents here. Okay, we subtract that discount from the bond payable, 1 million minus 66,240.9 gives me $933,759.10, which I could have just gone ahead and looked up here, at the table to see what the new carrying value is. So as you amortize the discount comes down. When the discount comes down, the carrying value of the bond comes up. Okay, now I don't want you to sit there and do that every single time you have a problem to figure that out. You just know, and you'll see questions where they're going to ask you the straight line amortization. You'll have to calculate that, but then they're going to either ask you what's the interest expense or what is the new carrying value of the bond? And the flashcard that you're going to put right here will be, and I want you to just write in here, how does discount amortization, I'm going to abbreviate that, amortization, affect interest expense and carrying value of bonds? Answer is what? It increases them. It increases interest expense above cash interest. And increases carrying value. That's CV, carrying value of bond. Okay, so again, when you get questions on the exam, they're going to give you a straight line amortization question. They're not going to stop there because that's too easy. You simply divide it by the period the bond's outstanding. It's going to be easy to calculate the discount amortization. What they're going to do is they're going to want to see, do you know what to do with that discount amortization? They're going to either ask you interest expense, or they're going to ask you the new carrying value after that discount amortization. You simply calculate the discount amortization, add it to the cash interest to get the interest expense, add it to the previous carrying value to get the new carrying value. Question? Okay, good. Now, if it is a premium, okay, and again, we issued this bond for $1,081,109. The face of the bond was $1 million. That difference is $81,109. When we issue the bond, we get that entire $81,109. The bond payable is always credited at face because we're going to pay back at face eventually. And then the difference is credited to the premium. Go ahead and tee up the premium. Okay, so 81,109. Okay, then what? Then we go ahead and we divide that by the period the bonds are outstanding. This was the 10 semi-annual periods because they issued these bonds January 1st. But read the question carefully to make sure that if they issue the bonds after the date the bonds are issued, then the outstanding period is going to be a shorter period than the total term of the bond, right? Here they issued it on January 1st. And so since they issued on January 1st, it was the full 10 semi-annual periods. Again, market rate was 8%. The bond is a 10% bond, so we know it's going to issue at a premium. We go ahead and we take that premium, we divide it by the 10 semi-annual periods. That means that the bond is going to have premium amortization of this $8,110.90 every 6 months. Okay, the 50,000 cash is not going to change. I don't care if it's a premium or discount bond, that number stays the same. And to calculate the interest expense, we would go ahead and subtract that premium amortization from the cash interest to come up with the interest expense. Okay, and then to figure out the carrying value, we subtract that premium amortization from the previous carrying value to come up with the new carrying value. Now, when you look at the journal entry down here, we are going to, of course, credit the cash for the full 50. We only debit the interest expense for the interest, the cash interest minus the premium amortization. What we calculate is our interest expense. We need a debit to make this journal entry balance. We debit the premium. So we debit the premium for this 8,110.90. Okay, and when we do, now the amount of the premium is this 72,000 $998.10. Okay. If we were to prepare the balance sheet now at June 30th, right, the bond payable, of course, is still showing $1 million. But now the premium is now what? The premium is now the 72,998.10. So the new carrying value of the bond now, right? Carrying value, just put carrying value CV is 1,072,998.10. You're like, yeah, John, we could have looked right up here to see it. And it's a little easier to visualize it with a premium because the carrying value always shows the face plus whatever the unamortized premium is as you go along. But I figured I'd be consistent with what I did with the discount when we discussed that. Okay, so now we're ready for another flashcard here. Okay, and this flashcard is going to say is how, okay, flashcard, how does premium amortization affect interest expense and CV carrying value of bond? Answer, what? It decreases them both, decreases interest expense by the amount of premium. I don't need to say that by the amount of premium amortization because that's what the question said, but it decreases the interest expense by the amount of premium amortization below the cash interest. And it does what? Decreases carrying value. So it decreases them both, right? And that makes sense. And that what? Eventually we're only have to pay $1 million on that bond. Okay. So again, when they ask you premium amortization questions, guys, do not expect that it's going to stop there when they ask you for it in a straight line. When they ask for it in a straight line, don't expect that they're going to stop there. I can almost promise you they're then going to take that and say, therefore, the carrying, they'll give you all the numbers you need to figure out the discount or premium amortization, using straight line. They'll give you all that, but then they're going to say, okay, now that we've given you all that information, what would be the effect on carrying value? What would be the effect on the interest expense for discount? You subtract that premium amortization from the cash interest to get the interest expense. For discount, you add the discount amortization to cash to get the amount of interest expense. For the carrying value, you add the discount amortization to the previous carrying value to get the new carrying value. For premium, you subtract them. You subtract the premium amortization from the cash interest to get the interest expense. You subtract the premium amortization from the previous carrying value to get the new carrying value. Okay? Question. Okay, good. Now, effective interest method, as we have said, is what's required by GAAP. Okay, so certainly the question is going to ask you that. Okay, so your interest expense is going to be whatever the carrying value of the bond is at the beginning of the period times the effective market rate of interest. That'll give you your interest expense. And then you take the difference between that interest expense and the interest payment, and that difference is going to be either, if it's a discount bond, the discount amortization, or if it's a premium bond, it'll be the premium amortization. Obviously, it can't be both. Now, notice, guys, the interest payment will be the same under both considerations, if it was the same bond, in one case it had issued at a premium, the other case it had issued at a discount, that's that 50,000. Again, it won't always be 50,000 on the exam. You get that interest expense that we calculated right there, and you compare it to whatever the cash interest is. That difference is the discount or premium amortization. And then if the problem were to ask you, well, what's the carrying value of the bond after you've amortized the discount or premium using the effective interest, that's the same as straight line. If it is discount amortization, it's going to increase the carrying value. If it's premium amortization, it's going to decrease the carrying value. That part doesn't change between straight line and the effective interest method. Okay, so you come over and maybe this is a kind of a good way that they showed it too, although I don't like the way they showed balance sheet, but this is also a way of showing you the amortization. I don't like the way they said income statement and balance sheet there, but that is how you calculate the amortization, the difference between the interest payment, which will always be in the bond that we're looking at, 50,000, and then you see how to calculate the interest expense. So let's just practice with that here. And they start us with the premium bond this time. And remember that the bond issued for $1,081,109, 8% is the interest on that, is the market rate of interest. They say to yield, or they call it the market rate of interest. The coupon rate was at 10%. So that 50,000 is not going to change. That's going to be the same, okay? But now we're going to take what? The carrying value of the bond at the beginning of the period. We take the market rate of interest, divide that by 2. This was what? The 10% divided by 2 times the million is what gave us the 50,000. That won't change. But the what we have to, for the effective, we have to use the market rate of interest. Instead it was 8%, divide that by 2, that's 4%. That gives me what? Interest at 43,244. That will, mathematics of finance, has to be less than the cash interest. That difference is the premium amortization. We take that, and what do we do with premium amortization to figure out the new carrying value? We subtract it from the previous carrying value per our earlier flashcard to get the new carrying value. That new carrying value comes over times 4%, gives me that. The difference is what? The 7,026. I subtract that from the previous carrying value, gives me the new carrying value. I bring that over, and so on. Okay. Now there have been CPA exam task-based simulation that maybe ask you to go through maybe 3 years, 3 periods, maybe 3, maybe they'll say it's a 3-year bond, and they might ask you to do this. If it's, by the way, if it's a full year, you don't have to divide by 2. You have to look at, how long are the payment periods. If it was a full year, you'd use the 8%, but since this was a semi-annual bond, we had to divide it by 2. But they could very well ask you to sit there and go a couple of rounds with the amortization in a task-based simulation. So you should be very, very good at this, okay? You should be able to kind of go through and figure this all out for your own. And I'll bet you, I'm almost certain, there is a task-based simulation sitting in your Becker homework for Chapter 5 that you should absolutely practice with. They'll ask you to do it for a premium, and they may also ask you to then turn around and use that same information. Okay, and you can see the journal entries here, guys. The journal entries, you're going to, credit the cash, the 50,000, debit the interest expense, debit the premium amortization. That's no different than what we had talked about under the straight line method. Just the dollar amounts change because we're using a different method. Okay, now you come over, and if it's a discount bond, the mechanics are exactly the same that we saw for the premium bond, but now because we have a market rate of interest, if we go back up to the fact pattern, because we have a market rate of interest on this one at 12%, right? In this example, now it's 12% divided by 2 gives me the 6%, right? The 50,000 is going to always be the same. Again, it won't always be 50,000, but for this bond, it would always be the 10,000 times the 10%, right? Divided by 2 is where they got that 50,000. You take the market rate of interest times the carrying value. They issued the bond for $926,399, so that's what it would be immediately upon issue. For the first 6 months, the interest expense is this $55,484. You compare that to the cash. Okay, so my cash is always going to be 50,000. The difference is the amortization. Okay, and what do? For a discount, I add the discount amortization to the previous carrying value to get the new carrying value. I know it's going to increase the carrying value. I get that new carrying value, bring it over, multiply it by 6%. That's my interest for the next period. That gives me this 55,919. That difference, I add to the previous carrying value. I bring that over, and so on. Okay. I'm not going to go through the whole table because I know you'll probably lose your mind if I do. Okay, but you should absolutely be very good at doing this for your exam. Don't go in with a weakness on this, because this is an area that the examiners think that they can take some points from you, and you're going to be very good at this and get some easy points and blast through any task-based simulation you get on this. Okay, now what I did was I just focused on the creditor here, the borrower, not the creditor, but the borrower here, this whole thing. But they do ask you a question about bond investment. Now, and amortizing a premium or discount for a bond investment. Now, this is a little bit tricky because we've already talked about bond investment in what's it, F4 now? Okay, where we talked about what trading, security, held to maturity, available for sale, right? We talked about all that. And we said that what there would be the interest would be part of the income stream, okay, that you would be calculating. If it was a trading security, the difference between the market and the carrying amount would be the gain or loss. If you take on a trading, that would affect the income statement. If it was a held to maturity, you wouldn't have to worry about changes in value. And if it was a available for sale, the difference between the carrying value and the market would be an amount that would be part of our other comprehensive income, right? We talked about that. All we're showing you here is how do you see how the amortization of discount or premium on a bond investment would affect the interest income portion of that. And that interest income portion hits the income statement, whether we're talking about a trading security, whether we're talking about available for sale, whether we're talking about held to maturity, the interest component will always hit the income statement, right? Okay, so we come over and we take a look at this bond, and we know that the bond has this, I'm just going to show you for the discount bond, has this $926,395. We're going to take that number and we're going to multiply it by the market rate of interest for every 6 months. We're doing this, right? 12% divided by 2. That gives me $55,583.70. Okay. Now Becker rounded that up to 55,584. Okay, that's the interest revenue. Okay, they did a little rounding there to bring that up to 55,584. Okay, now the cash that we'll receive is going to be the 50,000, and we'll increase the carrying value of the bond for that. Just like the carrying value of the bond goes up for the debtor, for the investor, it increases the carrying value of the bond. And so we debit the investment on the bond. So now the investment on the bond is going to be what? And I'm going to, kind of peek up here and just look at the new carrying value, because it would be the same for both. Is this 931, 983, right? Because the discount will increase the carrying value. So that's going to go up 931 to 931. What is it? 931, 983. And for the second period, I would multiply that by 6%. And there might be some weird rounding in here, but that should give me something pretty close to 5,919, give or take a couple cents, guys. I don't care. Okay, if that doesn't quite calculate straight up to that number, is materially correct. Okay, so I go ahead and for my second period, it's 55,919. That would give me what? That 55,919. The 50,000 stays the same. Difference will be adding to the carrying value of the bond and so on. And I would figure out the interest revenue for that next 6 months, increasing that carrying value of the bond, applying that market rate of interest. Okay, so you will see questions, primarily multiple choice questions is where I'm seeing this. You'll see multiple choice questions asking you how to calculate the bond interest revenue for the investor. Okay, we waited till now to talk to you about this because the mechanics you can see are really mirror images of each other. This could have been covered in chapter 4, however, where we talked about bond investment. Question. Okay, good. Let's come over and let's take a look. At what happens when bonds are issued in between interest payment dates. Now, what happens? You know, the bond is dated, say, January 1st, but not everybody shows up on January 1st to buy those bonds. Okay, so some people might come in a little bit later after the date the bonds are issued to purchase the bond, say, in this example, April 1st, a little bit after the January 1st date that the bonds are dated. That means that what? January, February, March went by, and the bonds sat on the shelf before anybody bought them. Now, what happens? If you have different investors buying those bonds on different days, you would have an accounting nightmare if you had to go and figure out what period each individual held those bonds and then write a check for different amounts to all different people. What the company wants to do is issue everybody a check for 50,000. So what they do is they figure out, well, how much interest is accrued as the bonds sat on the shelf. They make the investor give them that interest that is accrued. They hold it. And then when the regular interest payment date comes, they go ahead and they pay everybody out the full 50,000. So some of that money that gets paid is a return of the money that you held for whatever number of months, 3 months in this example, for the period that the bond sat on the shelf. You held that money and then you returned it back to the investor when you make your, in this example, semi-annual regularly scheduled interest payment date. So what happens? In this example, the bonds sat there and they sat there. Let me just, additional entries need to be made for the accrued interest at the time of sale. I just want you to make a flashcard of that just so that you remember, don't get tricked on a question where you don't do that accounting, okay? So if there's a difference between the day the bonds were issued and the day the bonds are dated, then you're gonna have to do this step, okay? So in this case, the bonds are issued January 1st, but they don't get around to issuing those until April. So that means the bond sat there January, February, March for 3 months. Be careful, guys. This is an area where it is very easy to mess up on the number of months if you're not careful in counting your months on your fingers the way I'm showing you, okay? And then what happens? They tell me that the face of the bond is $1 million and it pays interest on June 30th and December 31st. And they want to see, well, what is the amount of cash you would get at the time the bonds are issued? Now, the bonds, these were the discount bonds, so they issued for $926,399. But now we have to accrue interest, and this is the interest for what? Just mark down that this is the interest for January, February, and March, right? Okay, so that money we get up front. We say, hey, those bonds sat on the shelf for 3 months. Don't worry, we're going to give you that money back. But when we sell you that bond, you have to give us that money up front. Okay, so when we issue the bond, and the bond will always get more than whatever the issue price is when there's accrued interest, the 951,399, we're going to go ahead and we're going to debit the discount for the difference between the face of the bond and the issue price there. Okay, and then we go ahead and, guys, I don't know, I think this is a bad time for them to introduce reversing entries. So just have them credit interest payable. For 25,000. I'll show you what they're trying to do. We're trying to do there in a minute. It's just a bad timing the way they did it there. That's not the time to try to cheat you that. Okay. All right, good. Now that's for the interest for what? For January, February, March. Okay. But now we go and it's June 30th. Okay. So on June 30th, debit the bond interest payable for 25,000. That closes that out. That's for the interest for what? Jan, Feb, March. Okay. And we're going to credit the cash always for the 50,000 and then debit interest expense for 25,000. That's the actual interest that had to be paid for what? For April, May, and June, right? Okay, that really is interest because the bonds are outstanding, interest expense because the bonds are outstanding for April, May, and June. Now, all they were trying to do with that reversing entry thing, guys, and I don't know that the exam gets all hopped up on reversing entries these days. With that, you know, so they said, well, you could credit interest payable or you could credit interest expense. Basically, what they're saying, if you credit interest expense and you did that on April 1st, right? And then they said later you could debit interest expense or payable for 50,000, okay, if you went ahead and you debited the interest expense at that point for 50,000 because you credited the interest expense over here instead of the payable on 4/1, then it's 6/1. If you go ahead and you debit interest expense for the full 50,000 net, there'll be a balance of what? 25,000 in interest expense, which would be correct. But you know, I feel like this is, you know, somebody that, you know, involved with Becker and writing textbooks that got, you know, got a little full of themselves and wanted to really get fancy with you. I don't know that the exam's going to get off into that. That's all they meant by that. Okay. Okay, good. And then when we talk about year-end accrual, all they're telling you is, hey, if indeed, you know, they don't pay the interest until the next year, then you're going to have to be a good accrual accountant and accrue the interest. Not a big deal. Okay. So here they tell us, hey, that interest payment isn't going to happen. And, you know, you made an interest payment in July and the next interest payment isn't going to be on December 31st. It's going to be on January 1st. Well, you'd have to go ahead and you would have to do what? Figure your face interest. You would have to, of course, amortize the premium. Excuse me, you know, the discount in this case. You'd have to amortize that discount. Your discount amortization increases your interest expense to this 55,919. You set up the interest payable because you are going to have to pay them cash, presumably here that next day. And then you'd go ahead and you'd have credit to the discount, just like you would if you were amortizing the discount if you were making the interest payment on December 31st. Question. Okay, good. Now, last time I skipped a question. I promised you that we would come back to it tonight. because I felt that the timing of that question was, the placement of that question, the material was not very good. Now I just have to find that question. I think it was here. Yeah, so go back, and we are now in good shape to answer this question. We probably could have answered it before, but I don't like asking questions that are going to be covered in a lecture to come. I think it's better to give you the lecture than ask you the question. So let's just go ahead and let's take a look at this question. I'll put up the poll for you. Okay, and I'll give you some time to work with this one.
Professor, I don't have a survey poll.
Okay, I don't know. I see it.
Yeah, I
Everybody
don't have one either.
else? I don't know what to tell you. Let's see. Because I see it on mine. How about now?
Yes, we see it.
Yes.
All right. I don't know why I didn't go up the first time. Okay, we're coming up on 2 minutes. I'll give you about 10 more seconds. Looks like everybody's had a chance on this one, but just in case we got somebody who wants to still try it. Okay, I'm going to go ahead and I'm going to end the poll here. And okay, good. 82% of us got that right. That's great. Okay, that's good. That's good turnout. Now, the problem that I'm having though, even though we had a good result here, I want the person that picked A to tell me why they think A is the answer. So I find someone picking A, I find that troublesome. Okay, and here's why. Nobody picked D, which is good. When we look at this bond, they're telling us that on January 2nd, year one, okay, the bond had a face amount of 500,000, is 9% bond, 500,000, which are going to mature, some way off time in the future, which means the bond payable will not be 500,000 by the time we get to, 6 months later from the issuance of the bond. There's no way it's going to be all the way up to 500,000 by then. If the bond got issued for 469,500, can it possibly have to yield 10%? Can it possibly have the same carrying amount 6 months later? What happens to bonds that issue at a discount?
They increase.
The carrying value of the bond should increase, right? So there's no way, thank you, Rashad, there's no way that it can be the same. I know it has to go up. So, I mean, when you're looking at CPA exam questions, guys, you got to start to look at it that way of, wait a minute, I'm not here to show off at how fancy I can do my calculations. I'm here to get a good grade on this test, and I've got an issue of time that I need to get through all this material. So can I eliminate some things? So now you're down to 2. I mean, if they really wanted to be nice to you, they would have one of the carrying values being less and you'd be done. You wouldn't even have to do a calculation, okay? So you want to look at the choices in a situation like this. Unfortunately, they give me 2 that go up, so I have to figure out which one is correct. Now, even though they tell me that the interest is payable December 31st at the end of the year, they're asking me what would be the carrying amount of the bond 6 months later. And so we would be able to do this exactly how we calculated in the book to get the carrying value of amortization of a bond for 6 months and see how that amortization is going to affect the carrying value. We know it's going to increase it, but what's going to be the precise amount here in order for us to get this correct? So we look, and the cash interest on this is going to be the 500,000 times 9% divided by 2, because they're asking me 6 months later. So the cash interest is going to be 45,000. Okay. The interest expense is going to be that 469,000, what was it, 500 carrying value times, but now I have to pick up now I have to pick up that market rate of interest to yield rate, market rate, effective interest rate are all synonymous terms. You got to get used to that. That's that's 10% divided by 2, or 23,000. Where did I get 45,000 from? 22,500. I think the 45,000 was if we did the full year. 22,500 versus versus 23,475. That difference of of 975 is the discount amortization. And what do we do with discount amortization? We add it to the previous carrying amount of 469,500 that was given to me in the problem. And that then brings me up to the correct answer here, which was this 475, which most of us got. Okay, but there's no way it could be A, there's no way it could be D, so you could turn a question like this into a 50-50, and you start getting good at questions like this, guys, you're gonna be in real nice shape for the exam. Okay, all right, now with that, let's go ahead and let's come back to those other questions that were up next. Oh, sorry, I forgot to put the poll on. Can you see it?
Yes.
Okay, guys, I'll give you a little more time with this one. Sure what's holding us up here, but I'll give you a full 3 minutes. We're at 2:30 right now. Okay, looks like most of us have had a chance to work this one, so I'm going to go ahead and in the poll, share the results here. Okay, pretty good. I think, you'll find questions like this easy. So almost all of us got it right. 89% of us, whatever, but let's go ahead and let's just take a look at this one. Okay. And we have this bond that they have 600 bonds. The bonds are $1,000 each. Okay, So if we had issued them at face, we would have got what, $600,000? Okay, but they tell us if they issue them at 99. So when you see that, that means you have to take 0.99. If they said they issued them at 101, then you would multiply that 600,000 times 1.01 and so on. Okay, and you'll see that that's a pretty easy thing to get used to if you haven't dealt with that much before. When you look at some of your homework questions and stuff, you'll get real good at that. Okay, so that's that 594,000. Then they tell us the bonds are dated April 1st, year 1, mature April 1st, year 11, which wasn't relevant for us here. And then interest is payable on April 1st and October 1st. And they want to see what should be, would they receive from the bond issue. So they issue the bond on when the bonds are issued. They issue the bonds on July 1st. That means that what? The bonds were sitting there for all of April, all of May, all of June. They were sitting there for 3 months where interest accrued. So I would take that 600,000 times the what? 10% times they sat there for what? All of April, all of May, all of June before they got issued July 1st. So that's 3/12. Okay. So that means interest would have accrued what, 15,000? So I would collect that money up front. And so when I issue the bonds, I would issue them for 609,000. I'd get the 609,000. I would, of course, credit bond payable for 600,000, credit what? Interest payable for 15, and I'd get this debited cash to 609. And I guess I would debit the discount here for whatever the discount amount is. Question, 6,000, whatever it is. Okay, good. Let's take a look at this next one. Okay, guys, we're coming up on 2 minutes now, so I'm going to go ahead and end the poll for this one. And we'll take a look at this. Just about everybody got it right. Okay, I think we've got somebody who thinks they should just pick A, because I'm not sure how A would possibly be considered a right answer, but If someone wants to explain how they came up with A, that's fine, but you take a look at this one and what happens. We're looking and okay, we got this bond that is a $300,000 bond. Okay. And it's 12%. And we issued it at face, so we don't have to worry about any premium or discount amortization, right? They issued it at face and they issued it, it's a 12% bond. Okay, so now we're going to multiply that by the 0.12. And they want to know what is the interest payable at September 30th. And the bond has what interest payment date of June 30th and December 31st. So this bond paid interest on June 30th. It's going to pay interest again at December 31st, but they want to know what should it be on their, September 30th balance sheet. So that means that what the bond sat there for all of July, all of August, all of September for 3 months. So you multiply that times what? Times the 3/12. That gives you the correct answer here, the 9,000. Where did 27,000 come from? I'm not even sure how you get
I didn't thoroughly read the question.
Okay, but how do you get to, I'm just curious how you get to 27,000.
I didn't take into account the semi-annual interest.
Okay. So can you take 300,000 and multiply it by 12.12 and that gives you 27,000? Okay.
No, but it gives you 36.
Okay. So, but you see how we got to 9,000, as long as we're clear on that. I'm just not sure where 27,000 comes from. I was just trying to see that.
That's kind of the inverse in a way. If you look at the 9, the 37, the 27 differs from 36, the full year by 9. That's, opposite, but
Okay, so if you did it for 3/4 of the year, I guess. Okay, good. Whatever. All right, so let's go ahead then and let's take a look at troubled debt restructuring. Okay, now I see, and I really should just stay away from that whole little Facebook. I tell you to do it, and then I always go and find myself, it comes up on my Facebook feed, and I guess I like to torture myself because I read that thing and I'm just like, what are these people talking about? And one of the ones that I see a lot is, I don't understand troubled debt restructuring. Can anyone explain it to me? Okay, well, the reason I think that folks have trouble with it is it seems a little like they're making it up as they go along here, which I find when we're going to talk about leases, I feel like they're doing a lot of creative shuffling around of words there. But for this one, I understand the logic a little bit more, and maybe in part it's because I was on an assignment where Congress asked us to look at the standard setting process, and we actually sat down with the board member that was involved when they issued the standard on how to handle troubled debt restructuring. And one of the questions that we asked them is, well, how come when you look at the gains or losses associated with the troubled debt restructuring, how come you discount cash flows if you're the creditor, but if you're the debtor, you don't discount cash flows? And the answer was, well, if there's a troubled debt restructuring, there's going to be a gain to the debtor, and FASB wasn't comfortable with discounting cash flows and having debtors take larger gains when, if you're needing a restructuring of debt, you're probably an entity that's in trouble. So the compromise there, the rub was that they made the decision to not have the debtors discount their cash flows, but to have the creditors discount the cash flows. So that's why you see this uneven treatment. I think that starts to bring in some confusion. Okay, so we're going to look at what happens when there's a modification of terms on a debt restructuring. But before we do that, we're going to look at, well, what happens if we simply take something in exchange for a debt. And we're really going to be focusing on transfer of an asset like land or something in exchange for debt. Okay, now when we look at that, there's really two tranches to the discussion when you're transferring an asset, say land. Okay, first off, the company would have to figure out the difference between whatever the fair value of that asset is and whatever the carrying value, the book value of that asset was. And that could very well be a gain or loss. If the fair value is more than the book value, say I bought the land a long time ago, then, you know, I might very well have a gain. If the fair value had fallen below the book value of the asset, then that of course would be a loss. So that could be a gain or loss. Now, when you look at this gain, and it's always a gain, it's always a gain, you can put always, okay, it's always a gain. When you look at the difference between the fair value of the asset that's transferred, which we see that's the same amount that we would have had up there, versus the carrying amount of whatever the debt is. And I know that's always a gain, because if the fair value of the asset was more than the carrying value of the payable, what would happen? I'd sell the asset, get the cash, pay off my creditor, and keep a little bit of the cash for myself, right? So you know that whatever the asset is that they're transferring has to be less than the carrying amount of the debt. Thus, you will have a gain because you're getting rid of debt by only having to transfer an asset that's worth less. Same kind of thing if we're talking about equity, okay? If it's stock, then it's going to be what? Then it's going to be the difference between the fair value of the equity and the carrying amount, and that will always be a gain, because again, if I could sell my stock for more than whatever the carrying value of the debt is, I'd sell the stock into cash and pay off the debt, okay? Now, you come over and we talk about modification of terms, okay? And this is where I think, you know, that first part is pretty easy, but I think that sometimes folks get confused because they're sitting there and they're like, well, why am I discounting the cash flows in one case and not in the other? Okay, so a restructuring that does not involve the transfer of asset or equity will often involve modification of the terms of the debt. So they're going to give me longer to pay. They're going to reduce the interest rate. They're going to not make me pay back everything I owe, okay? But they're going to be getting something. So the debtor does not change the carrying amount unless the carrying amount exceeds the total future cash payments. And when we say total future cash payments, that's undiscounted. So let's say, okay, undiscounted, no discounting there. Let's say I owed you $1 million. And I was supposed to pay the $1 million over 10 years. And I said, look, I'm going to have trouble paying you the $1 million that I owe you over the 10 years. We need to modify the terms. And we sit down and start modifying the terms. And by the end of the negotiation, I agree to pay you $1 a year for 1 million years. What do you think the present value of $1 a year for 1 million years is? What would you guess is the present value of $1 a year for 1 million years?
0.
Pretty close to 0, right? Okay. So what happens if I discount it? Since I'm basically giving nothing to you to forgive that debt, that would be this $1 million gain. Meanwhile, I can only afford to pay you $1 a year for 1 million years. So what happens? We sit here and we say no. FASB said, no, don't discount the cash flows. As long as you're going to get $1 million, don't discount. if what you don't discount, you don't discount as long as you're getting $1 million, no gain. You never discount. Now, what they're saying is if the total future cash payments are less than the carrying value, then that is going to constitute a gain. Okay, so you can see here we say future payments. Okay, when the total undiscounted future payments are less than the carrying amount of debt, the debtor should reduce the carrying amount accordingly and recognize a gain on the restructuring of the debt. That will always be a gain, and it's the difference between the undiscounted cash flows and the carrying amount of the debt. That's going to always be the gain. Okay, so that's pretty straightforward. Now, when you look at the creditor now in a modification of terms, okay, and I believe that this is where students start to get a little confused, because then all of a sudden, when we're dealing with the creditor, this is the person to whom the money is owed, and there's a modification of terms. Take a look at what they do. Impairment should be captured as part of the entity's overall assessment of credit loss. Any losses of troubled debt restructuring should be incorporated into the creditor's estimate of its allowance for credit loss. And we're going to use a discounted cash flow approach. Okay, so we're going to be discounting the cash flows here. Okay, so that's the key thing. For the debtor, don't discount the cash flows. For the creditor, do discount the cash flows. Okay, and that difference between the carrying amount of the debt has to be set up as and the discounted cash flows, not of the debt, but of the receivable in this case, has to be a bad debt expense, and you credit the allowance for credit loss. So let's just go ahead and let's take a look at a couple of examples now. First, the transfer of the asset, okay? And the debt forgiven is $560. The carrying value of the asset is $360. And so we have a total gain of $200,000. Now, what they did here is they went ahead and said, well, the gain on the disposal, what is the fair value of the land? What was the book value, the acquisition cost of the land? So you have a $90,000 gain there. The debt is being carried at what? The amount owed is $560. You gave up land that had a value of $450. So the gain on the restructuring is $110. So the total gain is what? Is the sum of both of those amounts. And, you know, on the income statement, okay, you probably report this gain as one number, okay, could be one number. Okay, so if a question asks you what was the total gain, it would be 200,000. If they ask you what was the gain on the restructuring, you'd say the 110. If they say what's the gain on disposal, you'd say the 90. I have a feeling the question would just probably ask you what's the total gain, which the answer would be what? Would be that 200,000. Okay, which is pretty easy to figure out. It's the difference between the debt that was forgiven and the carrying value of the asset is a total gain. But you could do it in those two separate tranches if you wanted to. Equity would work the same way, guys. I'm not going to go through the transfer of equity calculation, and it's, you know, now instead of being land, it's just stock that you're trading. Okay, now let's look at the modification of term situation. Okay, now in this example, okay, we have what? We have a situation. Let's read the facts. Okay, on December 31st, Apex agreed to modify the term. The accrued interest forgiven, the interest rate was lowered to 3%. The maturity date was extended to December 31st, year 5. Now, I need to get back up into the facts here, sorry, because it's worth noting that the historical interest rate, the original interest rate on this thing was 12%. They borrowed 500,000. Okay. Now, what happens? You come over And when you take a look at this one now, we have what? We owe 500,000. Okay, they told us we'll forgive the 60,000 interest, but we're going to charge you interest, and they changed the terms to what? To 3% for years 4 and 5. So you're going to owe us a total of 530, undiscounted. Don't discount for the debtors. The carrying amount of the loan was 560. The total future cash payments undiscounted is 530. So that's a $30,000 gain on the restructuring. Okay, so take the old note payable off, take the old interest payable that had accrued that they forgave, and they say, well, now you owe us what? You owe us 530, and that's your note payable, and the gain here is on the restructuring is 30,000 because you owed us 560. No discounting there. Okay, now if we were sitting here and we were the creditor, now we would have to discount those cash flows. Okay, so you come over, and I don't know why they delayed the calculation here. They come over and they tell us, well, the present value due in 2 years at 3.5% equals 0.93 for the principal. That's that 46675. And then you have the 2 interest payments of 15,000 for 2 years at 3.5%. Okay, that gives us the factor for the 2 interest payments for 2 periods. There's a value of an annuity. You add those 2 together, and that means the present value. Now the creditor is using present value. What the creditor is going to get is this 495,255. The carrying amount of the debt before the restructuring was that 560. That number, which was the present value cash flows, and the difference is the loss on the restructuring. We are to debit the bad debt expense. We credit the allowance. That brings that loan balance down to the new present value of the 495,255. And then we go forward now accounting for that loan. Now, the important thing here was that what they used this 3.5% to come up with the present value of the cash flow. So they used that 3.5%. Where did they get 3.5%? I thought they said they lowered it to 3%. Assuming, here we go. Assuming the company utilizes discount cash flow approach and post restructuring effective interest rate of 3.5%. So the rate that we had to pick up there was 3.5. They used to use the historical rate, but I guess FASB changed that because there was some controversy about that when they were using the historical rate. So now they use whatever the effective rate was after the restructuring, once they go to prepare their financial statements. I guess that's where the 3.5% came from. Okay, so use that post restructuring rate. You probably want to flashcard that. They used to use the historical rate, but I guess they changed that. So in that particular thing, I said it was interesting to note that 12%, I guess now they've changed that. And you don't use that historical rate anymore. So you wouldn't use that 12%. Where'd that go? That would be a distractor. Where'd that go? Yeah, it's right here. The hell did that 12% go? You would ignore that. Okay, they used to use that rate. I guess they changed that now. Okay, question.
Sorry, can you confirm the amount we should be using? My book still shows 12% in that example when you're doing the present value of the restructured cash flow for the creditor. So we're supposed to be using the 3.5%, is that correct?
Yeah,
Okay.
apparently, who's that? Kylie, who said that?
Yeah, it's Kylie, yes.
Apparently that's one of those minor changes that they didn't issue new books for.
Okay, sounds good.
So I think if you look that up, that's what that is, yeah. And I kind of, because I don't have, I didn't sit there and go with a fine tooth comb for every single change. What I'm showing you on the screen is the correct. So I guess there was a small change in the standards that said, because that 12%, that was a point of controversy at the time. I think they passed that, whatever, I forget what FASB it was, that they passed at the time, but it was a 4-3 decision. And 3 of the members of the FASB members felt that they should use something other than, they felt that you should use the new interest rate. And the other 4 thought they should use the historical rate. So I guess as time's gone on, they've now moved back towards more the new rate than the historical rate.
Got it. And you use the 3.5% for both the present value of the 500,000 and the present value of the 15,000, correct?
I think so.
Okay, perfect. Thank you.
Present value is 3.5, yeah, and present value for the interest, yeah.
Okay, thanks.
Yep. Okay. Okay, good. Let's look at, let's see. Yeah, let's finish. I know we're going a little past the break time. Let's go ahead and finish chapter 5. Okay, I'm talking about, you want to finish chapter 5 or take a break right now?
I say
Okay.
finish.
Yeah, me too.
Knock it out. Okay. All right, good. Let's go ahead and let's knock it out. And all that's happening with the extinguishment of the debt. I'm a company that issued bonds. And those bonds are sitting out there. And I'm like, I want to call the bonds. I have cash available. So irritating. Sun did shine all day. Now it's going to be in my face. What happens? I'm sitting there and I issued bonds and I'm like, I got the cash. I want to call these bonds right now. Okay. And if you look at the bond, there's going to be some requirement that I'm going to call it. And when I call it, I'm going to either have to pay more than face or less than face to call that bond. Okay. Now, if I go ahead and I do it for more than face, I'll compare whatever the cash is that I get to whatever I'm owing. And if I am able to pay, if I am forced to pay more cash than whatever the carrying value of the bond is, that's a loss on the extinguishment. If I pay less cash than the carrying value of the bond, that's going to be considered a gain on extinguishment. Okay, so you're going to have to calculate the reacquisition price. Okay, and let's just think of a little too much detail here. Reacquisition price. Okay, and as we saw with that one question with the accrued interest, they could tell us what if it's 95 or 102 and say the face of the bond is 100,000 here, then what happens? Then that would mean that we'd have to pay 102,000 to reacquire the bond. If it said 95, that would be 95,000. I then compare that to the net carrying amount of the bond. The net carrying amount of the bond is going to be the face plus an unamortized premium, or the face minus unamortized discount and bond issue cost. Okay, now you come over and I guess you could flashcard this. Okay, and you look at it and we have a bond that we're having to pay 101. We do that calculation. That means we're going to have to pay, it was $1 million bond. We're going to have to pay $1,010,000 to call that bond. Okay. Now, the carrying value of the bond is, in this case, it was a discount bond face, less the unamortized discount and bond issue costs, mean that the bond has a carrying value of $937,208. That's what I owe the bondholders. And to cash them out, I'm going to have to pay $1,010,000. Let's say you owed $937,208 on your house. And the bank said, hey, you want to pay that off? Give me $1,010,000. Would you feel like you lost or like you gained? That's a question.
Lost.
you feel like you lost. You said, well, wait a minute, I only owed you 937 and I got to pay you 1,010,000 when I only owed you 937,208. That's a loss, right? Because you paid more than the carrying amount. Okay. Now, conversely, coming over to the gain situation, you have to call the bonds at 96. 1 million times 0.96 is 960. You had a face plus the premium. You owed 1,052,421. So imagine the happy situation of you owed $1,052,421 for your house, and the bank said, "Give me 960. We'll be good." You'd be like, "Oh boy, I just gained what? I just gained 92,000." Okay. Okay, good. Let's go ahead then, and let's take a look at a couple of questions, and then we'll be able to pull that break. Okay, guys, we're coming up on the 2 minutes, and I want to go ahead and end the poll here. So let's go ahead and take a look at this. And okay, most of us got it right. I mean, the first thing with this question would really be to, figure out, well, is it a gain or a loss, right? Because they're giving us those choices. And so the correct answer is B, but you take a look at this one, and they tell me that on March 1st, year one, SOMAR issued 20-year bond at a discount. Okay, by September 1st, year six, the bonds were quoted at 106 when SOMAR exercised its right to retire the bonds at 105. Now, I don't care what they were quoted at that time, but we're worrying about, what are we going to have on the retirement of these? And so I will need to consider that I'm going to, get these bonds at 105. I'm going to have to purchase them back at 105. If the bonds were issued at a discount, would they still be at a discount in year six if they're 20-year bonds? Yeah, it's going to take what? A full 20 years before they come up to face, right? So the bonds are still being carried at a discount, and I'm having to pay what? More than face to retire these bonds. So since I'm going to have to pay more than face and the bonds carrying amount is less than face because they were issued at a discount, there is no way that there can be a gain on this. We know it's going to be a loss, right? Guys,
Yes.
okay? And at no point in time did we ever talk about losses from early extinguishment of debt being considered comprehensive income. Comprehensive income, we talked about unrealized holding gains and losses on available for sale securities. This is not that. This is what? An outright sale of an investment, or not an outright sale of an investment, but a liquidation of debt. And we never talked about that being what part of our comprehensive income. So D is not correct. So it's just loss in continuing operations. Now, maybe you got a little shy about B because you were thinking they were talking about operating income. It could very well be what? Non-operating, but it is part of our income from continuing operations, right? Okay. Okay, good. Let's look at this one. Okay, guys, we're up on 2 minutes here, and I'm not sure why it would be taking us much longer. And I'm thinking maybe some folks took the break, so I'm going to go ahead and share the results for the folks that did choose one. Most of us, just about everybody got it right. Okay, but let's go ahead and let's take a look at this one together. Okay, and we have these bonds that they've issued. It's 600 bonds at 1,000, and they're going to use some of these proceeds to call this $1 million that they got. They're going to use some of it to call these bonds. So they have the 600 bonds, and they're $1,000 each. So the face on these bonds is what? Is 600,000. But they tell us that what? The premium relating to these bonds, okay, these were those bonds, is 65,000. So since the premium is 65,000 and the bonds have a face of 600,000, the carrying value, CV's carrying value of these bonds is 665,000. And they tell us that they called these bonds at 102. So if you take that 600,000 times 1.02, 0.02, okay? And you start bringing that in, you're having to pay 612,000 to retire bonds that have a carrying value of 665. That $53,000 is a gain, right? Now, you get into a lot of this language over here where they say it is part of a normal strategy and so on and so forth, whereas a typical risk management strategy and all that. You know, I really feel like that's Becker harkening back to the olden days where they used to say that if you extinguish debt early, that was treated as something called an extraordinary item. They don't have extraordinary items anymore, period, at all. Further, you know, even before they got rid of extraordinary items, they stopped treating the early extinguishment of debt as an extraordinary item because it was originally an extraordinary item because in the olden days, interest rates only went up. Now, as we know, interest rates fluctuate up and down. So it could very well be a normal risk strategy to take a bond that's paying a higher interest and go ahead and retire it early. And so it was no longer extraordinary when it was part of a usual management strategy. And then when they got rid of extraordinary, it can't obviously be extraordinary anymore. So when they're putting those phrases like that, you see that in parentheses. You know, if you see an exam question that starts talking that, don't let that mess you up. That does not change anything we did here. Okay. Okay, good. All right, that's enough for chapter 5. You now have everything you need to complete that chapter. When we come back from the break, okay, we will begin chapter 6, focusing on leases here tonight, and I'll talk to you about what I want you to do with the balance of some of this stuff in chapter 6. Let's go ahead and take the break before I blab anymore, and we'll come back at 7 o'clock. Okay. And let's go ahead and take a look at chapter 6. Okay, now tonight we're going to cover leases. Leases have long been on the exam. It's about a 5-point area. And you guys had asked that I go through that with you here together tonight. So we're going to do that. When you talk about derivatives, okay, very light on the exam, 2 points. I'm going to ask you to review that information on your own. Few pages there, you'll be able to look at the recording of whoever's teaching that section, and it's just a couple points there, okay? For the foreign currency, okay, I'm going to go over that with you next time. That in and of itself is a 5-point area. However, there have been dreams that I have had about things that could appear on the exam in which they ask you to do consolidation, 10 points on the exam, but they ask you to do a consolidation and they'll ask you to consolidate a foreign entity into a US company. And you're going to first have to convert the financial statements of the foreign subsidiary denominated in a foreign currency and either translate or remeasure that into US dollars before you can begin the consolidation. So even though in and of itself, foreign currency is maybe 5 points, if it's connected to consolidation simulation, then it could be more of a point value. And I think I've got some ways of helping you to interpret some of the information that's here in the book that gets a little twisted, in my opinion, at some point. So I'll help you with that next time. As we had voted last time, you wanted me to go through leases, so I'm going to do that. Income taxes, deferred taxes are a 10-point area of the exam. So you are going to have to spend some time with the recordings to look at that. So I will come back next time, talk about foreign currency. I'm not going to go into income taxes. We're going to talk about leases tonight, and you're going to need to look at that deferred tax discussion. Question? Okay, good. Now, I am going to talk about leases when we start out the discussion here of leases, okay? Basically, what we're talking about is when one entity gives another entity the right to use a particular asset. We're considering that a lease. And the way a long time ago, before my time, they looked at leases, they always looked at them as rental agreements. They'd say, well, you know, you're not owning the property, you're just leasing it, so just treat it as though it's a rental. And so what companies would do is they would go ahead and they basically be purchasing the asset, but they would set it up legally as a lease so that they wouldn't have to put this lease liability on their financial statements. So a long time ago, FASB 13, FASB looked at that and said, that's not right. And it came the time where you have to start putting a liability on your financial statements when you enter into an agreement that meets enough of the requirements that it is in substance a purchase of an asset as opposed to mere renting or leasing of an asset. So that's where we're going to be going with this. Now, when we look at some of this material here at the beginning, okay, they talk about lease versus non-lease components. They talk about combining contracts, etc. Guys, I don't want us to get bogged down in this stuff. I am going to ask you to also review this first section up to page, what page was it now? Sorry. Up to page, what page is this? Up to page 6 on your own. And then I'm going to pick up here now with page 6 because we can really get bogged down on what if it is more than one contract in the lease and whatnot. And I don't want us to get bogged down with that. I want to get to where I think most of those 5 points are going to be, which is asking you, do you know whether you have an operating lease or a finance lease? And if it is an operating lease versus a finance lease, what are the accounting implications around that? That's where we're going to spend our time, okay? Now, we're going to understand the criteria for determining whether something's a operating lease or a finance lease, spend some time with that. And then we're going to be looking at some numerical examples that show you how the accounting will differ depending on whether we're treating it as a finance lease or a operating lease. Now, when we look at this, they tell us that leases substantially transfer substantially all the benefit and risk inherent of ownership of property to the lessee. So the lessor is the person that's leasing the property to the lessee, but you're pretty much giving them all the risk and rewards associated with that. So we're going to have to put a liability for the lease and a asset for the lease on the books. Okay, and we're going to be seeing that those methods will differ depending on whether it is an operating lease or a finance lease. Okay, so you can come over and you can see that for both the lessee, that's the person that is basically renting the property, from the lessor, okay, at least the legal setup is you're renting it, the accounting, the economic is you're really purchasing it, you're the lessee, and you're purchasing. If you're the lessor, you could be the seller, and that can either be an operating lease for either, or it could be what? A finance lease for either. Okay, and then when we get into the finance lease for the lessor, we could either have a sales type lease or a direct financing lease. Now, if it's a sale type lease, there will be gain on sale. If it is a direct financing lease, there will be interest revenue only, and that's going to come a little bit later, and we'll explain that a little bit later, but I figure I might as well set you up with that now, that understanding now. Now, we say here and we look, And we say that when the lease starts, at the onset of the lease, both parties must determine whether the lease will be classified as operating lease or a finance lease. Makes sense because that's the options that they have there. And the assessment is based on a set of criteria below, okay? And when we look at these criteria, they tell us that any one of these 5 criteria are met, then for the leasee, it is going to be, if any one of the 5 criteria is met, the leasee will classify it as a finance lease, thank you. And the lessor will treat it as a sales type lease, okay? Now we're gonna see that the lessor is going to have the chance to treat this as a direct financing lease in a second, what criteria is for that. But for the leasee, it's a finance lease if we meet any one of these criteria. For the lessor, it'll be a finance lease. What type of finance lease? A sales type lease if they meet any one of these criteria here. And then we'll see what happens for the direct financing lease on the next page. Okay, so if there is an ownership transfer, that's an O in the box, and you can, this is one where I believe in the mnemonic, and I do want you to flashcard that you only have to meet any one of these criteria, okay? Ownership transfer. If there is a written option to purchase the underlying asset, okay, and it's reasonably certain that they'll exercise it. Basically, the problem will either tell you that it's reasonably certain that they'll exercise it, or the exercise price will be below what they anticipate the fair value of the asset to be. So obviously you're going to exercise that because then you can purchase it for that amount and then sell it for a higher amount and get some money back on that. Okay, so that would be indicating that you're going to exercise that option. It's reasonably certain that you'll exercise it. Okay, the net present value of the lease payment equals or exceeds substantially all of the underlying assets fair value. Okay, now in the olden days, that meant that the present value constituted more greater than or equal to 90% of the fair market value. So, you know, it's got to be a good chunk of that fair market value what the lease payments, present value of the lease payments constitute. Okay, the economic life is a major part of the lease term, is a major part of the economic life. In the olden days, that was 75%, equal to or greater than 75% of the life. The lease term was greater than or equal to 75% of the life of the asset. I don't know if I'm putting my greater than or equal signs in the wrong direction here. I think I am. Right? Fair market value is greater than 90%. No, I have it right. Sorry, guys. Okay. Anyway, the point being here, and let me back up with these first 3. Okay. Remember, companies were leasing things and trying to act like they were just renting them, but in fact, they were actually buying them. So think about it. If there's an ownership transfer, you're going to get the thing, you're buying it. If there's a bargain purchase option at the end of this thing, you can buy it for, you know, and you're going to reasonably expect to exercise that to buy it at the end, you're going to do that. If the present value, you're essentially paying the fair market value of this property now, you're buying the thing. If what, you're going to have it for most of its economic life, that's like buying the thing, right? And so they started to look at these kind of criteria and say, if that's the case, you're going to have to put an asset and a liability on the books. None of this acting like you're renting it period to period and just putting down, you know, rent expense each month, okay, or each year, whatever. Okay, the asset is specialized. You make me say, hey, I want you to lease me a car and I want it to be, you know, pink with green interior. And you make it, you know, for me, pink with green interior. Well, you know, the chances you're going to be able to sell that to somebody else is not very likely. You specialize that for me. I'm the one that's going to end up taking that thing, right? Okay. Now, you can see that if is you only have to meet one of them. And it makes sense that you only have to meet one of them because once you've triggered one of these, hey, you're buying the thing, right? If none, excuse me, I'm going to do something about this. 1 second, guys. Okay, now, if none of the criteria are met, okay, or the lease is considered short-term, which is defined as less than 12 months, okay, then it will be treated as an operating lease. Remember, these were the criteria for what? For a finance lease. It will be treated as an operating lease by the lessee. Flashcard that's for the lessee, okay? Now, if you look and you say, for the lessor, if none of the criteria above are met, the classification will depend on whether both of the following criteria are met, okay? Now, think about it. We're sitting here and we're saying, okay, we still may have a financing lease for the credit, for the lessor, excuse me. And remember, we have two choices. They already told us that if we meet any one of these criteria, it'd be a sale type lease. So maybe we're going to see why we should come up with a direct financing lease here, right? And they tell us that what? And this can be PC. We can flashcard this. The present value of the sum of these lease payments, lease guarantee residual value not included in the lease payments, okay? So it would be the sum of the lease payments and any lease guarantee residual value that is not included in the lease payments. In other words, they're saying you'll probably have to cough up a guaranteed residual value at the end of the lease. You know, sometimes lessors will want to protect themselves. You're going to beat this thing up and they're going to hand them back up a hunk of junk. So they say, hey, you have to guarantee at least that it'll be worth this, and that'll come at the end of the lease. So if it's not included in the lease payments, then you would include it. If it's included in the lease payments, then you just pick up the lease payments. But the present value of those and any third-party guaranteed residual value is equal to or substantially exceeds the underlying fair value of the asset. Okay, if you meet both of those criteria and collection of the lease payments in any amount necessary to satisfy residual value guarantee is probable, you meet both of those, then when both of those criteria are met, then we will treat it as a direct financing lease. If only one of those are met, then we will treat it as an operating lease. So we finally got down to what? To the operating lease when we didn't meet both of those two criteria for the lessor. Okay, so for lessee, what? You have to meet any one of these, then it's going to be a finance lease. If you don't meet any of those, it is what? An operating lease. If we are the lessor, we meet any one of those, it is a finance lease, a sales type lease. If you don't meet any of those, then you have to continue on to these other two criteria. If you meet both of them, then it is a direct finance lease. If you only meet one, or obviously I guess none of those, then it would be treated as an operating lease. Okay, and then everybody treats it as an operating lease if it is less than 12 months. Okay, question. Okay, now we come over and you don't need a decision tree on that. I had you flashcard the the approaches here. But let's look at this, the criteria, but let's take a look at this example here, okay? Now, we say that an entity leases equipment with a fair value of $3,500. Lease payments of $1,000 per year are due annually on December 31st. The lease term is 4 years. The asset life is 10 years. Now stop right there. 4 divided by 10 is what? 40%. Do you think that that constitutes, because remember we had what? We had up here the life. Do you think that constitutes a major part of the economic life?
No.
No, it's not even getting up to half. So it's going to be no to the economic life question. So that's a no. Okay. But remember, we only have to meet what? We only have to meet one. That N stands for no. Okay. Then it says the lease does not transfer ownership. So we're not going to get the O in there. That's a no. The N I'm putting here is not whatever the mnemonic was. And there's no purchase option at all. So that's a no. The asset is not specialized. That's a no. So have we met any of the criteria? Well, we have to consider that what? That present value of the lease payments are substantially all of the fair value. And so we take a look and you use present value, guys. You have to use present value. So these cash flows, and by the way, they show them discounting the cash flows one at a time here. You'd probably lose present value of an annuity factor because it's $1,000 a year for 4 years. But when you do, you come up with this present value of 3,170. That 3,170 fair value of the property is 3,500. It's what? It's greater than 90%, isn't it? So that is probably what meeting that criteria up there, which is the net present value of the lease payments equals or exceeds substantially all 90%. Okay. Okay, good. Question. Okay, good. So you will see, you know, that you can take that quantitative approach to look at the whether or not it's a lease, operating lease, or a finance lease. I always want to say capital lease. They used to call them capital leases, but now they call them finance leases. You meet any one of those, it's going to be a finance lease for the lessor. I mean, for the leasee, the lessor. If you don't meet any of those, you got to keep going with the lessor for those other two criteria to see if you've got a sales type lease or not. Okay, good. Lease term. I don't know. I don't care about the lease term. They'll tell you the term of the lease. Let's look at lease payments, okay? Because they'll give you different payments, and you have to know whether or not those payments are considered part of those payments that you'll be considering the present value of, to see if indeed you are, you know, the lease payments constitute substantially all of the fair market value of the property. Okay, so when you're looking at lease payments, we're talking about dollar amounts. Okay, and let's just go ahead and take a look. The required contractual fixed payments, okay, whatever those are, you can flashcard these. And I'm not sure, maybe I'll be able to figure out the mnemonic after I go through this. So I might be able to put in these bubbles here, but I definitely want you to flashcard the payments that should be included. So the contractual payments, you know, it'll say, you know, you're leasing this for $1,000, $5,000 a year or something like that. Okay, the exercise option, reasonably assured, what are you going to have to pay? So if it's looking like you're going to have to pay money out and you think you're going to exercise that option, that's money going out. Okay, purchase price at the end of the lease, if there's a stated purchase price of an underlying asset at the end of the lease term, which the lessor has the option to require the leasee to purchase the underlying asset, then you include that. Now you may say, well, maybe you're not going to. Well, rule of conservatism says what? You assume that you're going to have to pay these amounts out, because remember, we are calculating a liability. Okay, only indexed or rate variable payments. Okay, so if there is something that is indexed and they tell you that it's indexed, then you would go ahead and you would include that payment. This one is a little tricky the way they've shown this, because sometimes they'll say there are payments that are due to some sort of use. If you go over certain miles or something, you have to pay more. A lot of times, like when you rent a car, they'll say, well, your lease amount is this, and you have this much mileage, 20,000 miles a year. But if you go over that, over the term of the lease, then you have to start paying 25 cents per mile or something like that. You wouldn't include those. It has to be indexed or a rate variable payment. In other words, they'd say you have additional payments that you'll have to pay an additional amount over and above whatever the fixed payments are if the price index goes up to a certain amount. And then you only take those difference for the indexed amount in the period when you go over, say, a consumer price index or something like that. Payments that are based that are based on additional use, you do not include those, because you don't know if you're going to go over that additional use. Okay, any residual guarantee likely to be owed, termination penalties reasonably assured. Okay, so let's see if they give us, if I can take the first letter of each one of these to get a mnemonic. Repo. I don't know what the mnemonic is, just flashcard fees. I don't want to put that because I can't figure out what their mnemonic is. Just flashcard it. You don't care what their mnemonic is. You can look that up if you want. I'm sure it's on a flashcard somewhere too, with your flashcards that you got. Lease payments may or not include the following. Okay, it's at the leasee's option. Non-lease component amounts allocated to non-lease component of a contract. And leasee lease payments will specifically exclude guarantees of lesser debt by the leasee and other variable lease payments other than those that are noted above. And we said those that are indexed. Okay, now this index one, guys, I know is a little bit hard to kind of picture. So put down here, see example 4. And we'll come back to this example 3, but let's just look at the example 4, because I know that's probably the one that's bothering you a little bit. So they tell us that Bowdoin Corp is the leasee for 2 separate lease agreements. Lease A involves monthly payments that are based on changes in the consumer price index. Lease B involves monthly lease payments that are based entirely on Bowdoin's use of the leased asset. Okay, so for Bowdoin, the calculation of lease payments for lease A will include the variable monthly payments because they are based on an index rate. So they'll say that payments are $1,000 a month, but then that could be more because it'll be indexed. You use $1,000 a month, you're not going to anticipate what the index is, but those payments would be included. If they say there are payments based on, 25 cents a mile as you go over certain miles or something, you wouldn't include that because you don't know if you're going to go over those additional miles. You're going to have to pay that base amount, and it'll be indexed in the future to higher amounts that you'll have to take as a different amount over and above what you're paying now. What the base amount is will be treated as expense in that period. And then if it's saying that it is based on, amounts of usage later on, you wouldn't include those. You wouldn't say, well, I think I'm going to go, 500 miles over the limit, so let me include those payments now. Don't include those. Okay, now you come back to option 3, and we're saying here, illustration 3, And we're saying sterling is a leasing for a piece of movable equipment with a useful life of 8 years. Along with the equipment, the lessor is providing scheduled maintenance and upkeep that is accounted for separately from the lease. The term of the lease include the following. We have a 3-year lease with fixed monthly payments of $3,450. First 4 months are free. I'm underlining that because we're going to see that that's going to be an important trick on the question when they say some months are free. An option to purchase the asset for $12,500 at the end of the lease, which sterling is unlikely to exercise, and then $8,000 allocated to maintenance and upkeep of the component of the agreement. So lease payments, $4,350. It's fixed month payments, 32 months, because the 36 months are free. So you'd be looking at 32 payments because they're telling you that those first 4 months are free. So you're really going to be making $3,450 over 32-month period, right? So be careful with that. The option to purchase $12,500 is not included because they're unlikely to exercise the option. Okay, good. And then the $8,000 allocated to the maintenance and upkeep portion of the contract is also not included in the lease payments. That again is non-lease components. The amount allocated to non-lease components, you don't include those. Okay, and then for the variable payments to exclude, if the thing is saying these payments will be variable as the consumer price index changes, then include, you don't know what the future consumer price index is going to be. So you don't guess it, you know, what it's going to be. You'd include that base amount as part of the lease payments. But if they tell you there's going to be additional lease payments based on usage, you do not include those. Now, you look at discount rate. Okay, and they're going to give you a couple of different rates probably in any problem you look at. Okay, and you need to know which rates to use because they'll give you a couple. Okay, in a problem. So the rate implicit in the lease, if it is known. Now, sometimes the students will say, well, how would you not know? Sometimes these leases are written in a way where they don't make it very easy to figure out what is the actual interest rate that you're being charged on that. So you can't use the rate if you don't know it, or if the rate is not readily determinable somehow. You don't know the rate, you can't determine the rate, you can't use it. Okay, so even though they may say the rate implicit in the lease is this, but it is not known by the lessor, then the lessor can't, and it's not known, excuse me, by the leasee, it's not known by the leasee, then the leasee can't use a rate that they don't know or they can't determine. And so if that's the case, then they would use the incremental rate for the leasee, the rate the leasee would be charged for a collateralized loan with equal payments and similar lease term to the lease. You'd have to look to see what other ones are, and you use either of these. Okay, but you'd have to figure out the present value of the minimum lease payment by using either of those. And if they're telling you the rate implicit in the lease, it has to be known by the lessor. So even though the lessor will know the rate, the leasee may not know the rate. And so you'd have to, you know, use then this incremental borrowing rate. Okay. Okay, good. Now you come over and let's take a look at these indirect costs. Okay. And initial direct costs. Initial direct costs will be included in the valuation of the right of use asset. We're going to see how that right of use asset is going to be booked here in a second. And these costs are only incurred as a result of the execution of the lease. Any costs incurred prior to signing the lease, which can include lease term negotiations, document preparation, are not included in accounting for the direct costs. Okay, so in other words, don't include costs before you know that you have some sort of an agreement, right? Don't include those. Include other initial direct costs that are incurred as a result of the execution of the lease. Now, sale leaseback, we're going to come back to this. I'm hoping we can come back tonight. Okay, so I don't want to do this now because we kind of start getting off. I'm saying come back, not cow back. Come back to this. And the reason I'm saying I want to come back to this is I feel like we've set you all up to see what to include as payments in the calculation of the right of use asset and the liability. And then, you know, we stop and talk to you about something else. And then we, you know, which is sale leaseback. And then we start talking about how to calculate all this stuff. I think it's better if we go to that now, look at the numeric examples. I think you'll see it's pretty straightforward. I know we threw a lot of definitions and words at you here, but I think when you see how it lays out in numerical examples, you'll see that this stuff is not that bad. Okay, so let's just go ahead and let's jump over now to yeah, we can do this question. Let's do this question because it's just testing the definitions, and then we'll come back to question 2 after we talk about the sale leaseback. Okay, let's take a look at this one. And looks like everybody got this right, but let's go ahead and take a look at this one to help us to practice with some of the criteria. And so Watts Inc. enters an agreement to the lease printer copier from Jennings. The lease is for 3 years and does not stipulate an ownership transfer. Okay, so we don't have that. Or contain written option to purchase, so we don't have that. The printer copier has a 5-year life. Okay, well, it has a 5-year life. The lease term is 3. We're getting what? Well, at least we're past 50%, but we're not substantially all at this point. So I'd say we don't have the use of the life. Get rid of that. Okay, and then the net present value of the lease payment is equal to approximately half. Okay, there is no guaranteed residual value. Okay, so we haven't seen any of the criteria here for what? For the leasee to treat this as a finance lease. So this has to be what? This has to be an operating lease, and we didn't see, so it was either C or D there for the leasee. And then for the lessor, we didn't see what? we didn't see any of those other two criteria coming up down there, which was this notion that there would be the no, I forgot the last two criteria again, sorry. What were those additional two other criteria? The key of the C, the present value of lease payments, lease guarantee included in the is substantially all no. And so we wouldn't have to worry about the collection. So neither of those criteria were met. So it would be classified as an operating lease. Okay. Okay, good. Come over and let's take a look. We'll come back to this question too. So let's just come over to module 2 now, and let's start taking a look at now how we'll actually do the accounting. And we'll look at the accounting for the operating lease. We'll look at the accounting for the finance lease, both from the lessor and the lessee standpoint. And then if we have time, I don't know if we will, I'd like to go back and go look at that sale leaseback thing, but we may not have time for that. But let's go ahead and let's take a look at the operating lease, okay? If the lease is an operating lease, the balance sheet will reflect a right of use asset and lease liability, and both will be amortized over the life of the lease using the effective interest method, okay? Now flashcard this because the amortization of both of those is going to be the same. When we get into the finance lease, we're going to see that the amortization of the liability and the depreciation of the asset will be two different amounts. Here, we're going to see they're going to be the same exact amount, okay? Now, the right of use asset and lease liability amounts are calculated using the present value of the lease payments using an appropriate discount rate, okay? You can go ahead and you don't have to flashcard that. Note that on the income statement, lease expense will be recognized each year using the straight line method for expense measurement, okay? And then important flashcard down here, instead of reporting interest expense on the income statement, the lease will report interest as part of lease expense. So the interest, the amortization of the asset and the interest expense will both be treated as an expense on the income statement, okay? Now let's just go ahead and they give you these journal entries, guys, and journal entries without numbers are not very helpful. I'm going to ask you to flashcard some of these journal entries here, but I want to show them to you with the numbers, okay? So we come over and they say on January 1st, year 2, a lessee enters into a 3-year lease, and they just tell us that it is an operating lease with annual payments of $18,000 per year. The first payment will be made December 31st, and the interest rate implicit in the lease is 5.75. The present value of the ordinary annuity is this 2.6 whatever, and the problem would probably give you that present value factor, okay? So what do? We go ahead and we take a look. They want us to prepare the journal entries, which there's really not much to the preparation of the journal entries year after year because they almost are identical. But the first thing we would do is take this, and I don't know why the book didn't show you how they calculated that, but we would take that 18,000, okay, and we take the 18,000 and we have to, one second, guys. Okay. I don't know, I believe in showing where they get numbers from, so that 18,000 times this 2.685424 gives us this number, okay? And that present value of those payments that we had to include the annual payments that we had to pick up. We knew that that was one of the payments we had to pick up. And that was the only number they gave us here, the dollar amount on it, is set up as a flashcard. You don't have to put the dollar amount and how you calculate it, but you would have the right of use asset, lease liability. So you're putting it into asset and liability because they're saying, hey, you're essentially buying this thing and you have this liability. Okay, it's a financing agreement essentially. Okay, now what happens? Then they go ahead and they say, well, look, you've got this 48,338 of this liability, and they tell you that the interest rate is what? 5.75. So you put this 0.0575, I guess. And when you put that in, you get what? You get this interest expense of 2,779. Now, the difference between the payment of 18,000 and this 2,779, okay, is going to give me this 15,221. So I'm essentially going to amortize that liability, but I'm also going to amortize the asset at that same rate. Okay. So now when I go ahead and I report my lease expense, notice guys, is the sum of what? The reduction in the liability and the reduction and the interest expense together. They call that whole amount, that 18,000 lease expense. Of course, I have to credit the cash, and I go ahead and you will always reduce the lease liability and reduce the asset by the difference between whatever the lease expense is, the lease payment is the lease expense, and the amount of the interest portion. Okay, so you're taking what, in effect, if you think about it, you're taking as lease expense. And if you were getting a question like this and they told you that the payments were 18,000, they ask you what the lease expense is, your answer would be what? 18,000. So it's kind of like setting it up like a rental agreement in which you're crediting cash and you're taking an expense. But what they wanted you to do was at the onset of the lease, recognize the balance sheet effect by bringing that right of use asset on the books and bringing that liability on the books, okay, at that point in time, and then amortizing that down at the same rate over the term as you go ahead and you make the payments. And then as you go through the rest of this, because they asked it for the different years, now again, it's simply amortizing that liability that as the amount that gets paid goes out as 18,000, but then you have the difference between the 18,000 and the interest expense. More goes towards the reduction of the asset as you amortize that down. Question. Okay, now finance leases are more like a financing agreement in which we're going to be recognizing the difference between the true interest expense portion of that, of the payments, and the amount that is actually going to pay down that lease liability. Okay, so if the lease is a finance lease, the lessee will recognize both the right of use asset, corresponding liability on the balance sheet, very similarly to how we saw before for the operating lease. The liability will equal the present value of the lease payments owed. The right of use asset will include initial direct costs such as commissions, legal fees, consulting fees, any fees that you paid once you knew you had the contract, right? that were result of the lease execution, as well as lease payments made by the lessee to the lessor at or before the lease commencement, deposit, anything like that, down payment, and any incentives received, the lessee from the lessor will reduce the value of the asset. Yeah, that's a lot of stuff there. I don't know what you do with all that. I guess you could flashcard out ahead and all those things. That's a lot of junk and stuck in there. I think we already talked about different payments that should be included. Okay, but let's go ahead and we're going to be dealing with amortization expense now, the way you would similar assets. And so now you take a look, and the lease qualifies as a financing lease. So again, that initial setup of the asset and liability is the same. You go ahead and you pick up that 18,000 times that factor that now they decided to just go ahead and not give us, but you saw the factor in the previous example, so I guess they don't need to repeat it here. There's my right of use asset set up, so that's the same. Then I'm going to go ahead and I'm going to amortize it, and notice what I'm going to do. I'm going to take the total lease expense here, which is going to be the sum of the interest expense and the amortization expense. Okay, so the interest is going to be calculated by taking what? That 48,000, write it here, times, and I'm going to pick up that 0.0575. That gives me the portion that's the interest expense. That, of course, is reported on the income statement. I'm paying what? 18,000. Okay, so I'm going to do what? I'm going to go ahead and debit the lease liability by this 15,221. That's the difference between the 18,000 and the 2,779. Okay, so that's where I got the 15,221. Okay, but then I have to depreciate the asset here. Okay, so when I depreciate the asset, the amortization expense, now I'm going to go ahead and, like you would do any calculation, they tell me it's going to be amortized, that asset is going to be amortized over what? Over 3 years. So the 48,338 divided by the 3 years gives me that $16,113. So when you take the amortization expense plus that interest expense, right, that could be the total. That would be how you'd calculate the total lease expense. So notice here it's different than it just being the cash that went out. The lease expense is the sum of your interest expense as you amortize the liability and your amortization expense. They don't call it depreciation expense, but it's essentially depreciation as you're depreciating that right of use asset. And then you would continue on like that, amortizing the liability. Of course, since you're amortizing the straight line, the amount stays the same for that year over year. Here, less payments go towards interest as you pay down that lease liability. They could ask you the carrying value of the lease liability after these different years, et cetera. They just want to see, do you know what you're doing with this finance lease? Question? Okay, good. I'm not going to go through each year's calculation. Now, how do we want to do this? Yeah, this isn't going to work. Timing is not good. How Okay, I'll tell you what, guys, we're not gonna finish this module. It's not gonna work. So that makes sense. Go ahead. And you should be able to work module 1 if you look at that upfront stuff. Sales lease back, though, is the only problem there. Is this is kind of melting down on me here. I'll tell you what, finish chapter 5. Okay, don't worry about trying to work any of this stuff in the homework now, because I think it's going to be too confusing for you. So this is what I want you to do going forward. Finish chapter 5. We're done with chapter 5. We can at least say that. Chapter 6, I need you to look at the derivative stuff and the deferred taxes. Look at the video on that. You should be able to do that. Next time we will come back and we will complete the lease discussion for chapter 6. That will not take us the full 3 hours. So we should be able to start jumping in to chapter 7 next time. Okay. Oh, and I'll talk to you about foreign currency as well, and then we'll jump into chapter 7. Okay, guys, sorry, I thought we might be able to get through it, but it's not working. So that's all right. We'll come back next time. We'll finish the lease discussion. We'll do the foreign currency discussion, and then we'll get into chapter 7. In the meantime, do the taxes and the derivative for chapter 6 and finish your chapter 5 homework. Okay, guys. I'll see you next time.
Thank you. Have a good night.
Good night.
Thank
Thank
you.
you.